Hello and welcome. I'm RealCrowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of RealCrowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Today, we're joined by Doug Ressler, Manager of Business Intelligence at Yardi Matrix and a friend of the show. Yardi Matrix offers one of the industry's most comprehensive market intelligence tools for investment professionals. Whether you're an equity investor, lender, or property manager, they provide data and management solutions for multifamily, student housing, industrial, office, and self-storage property types. In today's conversation, we walk through Yardi's latest Multifamily Outlook report, which you can find a link to in the show notes. The conversation covers the supply and demand drivers impacting multifamily, the cities experiencing the fastest rent growth, the markets to be wary of, and what the inflationary environment might mean for multifamily. We hope you enjoy this conversation with Doug, and please again check the show notes for a link to the full report from Yardi Matrix. Well, Doug, thank you so much for joining us again today. We had you on earlier this year to talk about a few things and general update on the economy, and you guys just put out the summer 2021 multifamily outlook for the U.S. Thank you so much for jumping back on and sharing some new info with us.
Always a pleasure to be here, folks.
So, Doug, before we get started, for new listeners, maybe they haven't heard the last episode. If they haven't, we'll include links in the show notes. Tell us a little bit about yourself, Yardi Matrix, and what you do there on the day-to-day.
Sure. My name is Doug Ressler, and I'm the Manager of Business Intelligence at Yardi Matrix, which is a subdivision of Yardi Systems. Yardi Systems is a provider of asset management software, along with many divisions that also do data collection in terms of various commercial real estate endeavors. Yardi Matrix collects data for the residential, self-storage, student housing, single-family build for rent, and others. We also share data with our sister divisions, Commercial Edge for office and industrial, and also Rent Cafe, which is a B2C type of publication for the commercial real estate industry.
And now it's got to be a fascinating position to kind of sit on top of all of this data collection and try to figure out unique insights to it. I mean, how did you get into that again? And tell us a little bit more about your role within Yardi Matrix right now.
Sure. I started out initially with a company called Pierce Island in 2008, and they were acquired by Yardi Systems in 2013. I started out as just as a researcher. Our value proposition is that we don't do any web scraping. We call all our clients in terms of the commercial real estate endeavor that we're researching, like residential, and that is quite extensive and labor intensive. So I started out in that endeavor and eventually moved up the food chain to become more of an analyst and in business intelligence to connect the dots, if you will. Once you collect so many dots, you begin to have a certain affinity, if you will, for how those dots interact or don't interact together.
Mm-hmm. And culminating in the report that you guys just put out, again, we'll have a link to that in the show notes, the U.S. Multifamily Outlook for the summer 2021. It feels like it's been a fairly short few months since we spoke last, but it feels like there's been a fair bit that's changed and some that still hasn't changed, right? Well, still some of the uncertainties that we were facing earlier days in the pandemic as well. So why don't we just take kind of a bigger snapshot of where is the economy at right now relative to maybe where we were earlier this year?
Well, the economy is starting its slow transition back. I think, there's a lot of things out in the industry today, like the Fed is considering their QE reduction program that they announced at Jackson Hole a couple weeks ago. And you can begin to see the employment numbers perk up, even though the last employment number wasn't so great. But you're beginning to see that slow progression. The Delta variant has really kind of inhibited, if you will, the growth. And so you're starting to also see the impact of the Delta or whatever variant there is, especially in those industries like the leisure and hospitality, the affordable and the working class, blue collar working class job employment. They're really a bifurcation of the two distinct types of labor pools. The labor pool of being able to work from home in high-end salary jobs has not been as impacted as much as the lower-end jobs, which are more of a service industry related.
And how has that changed from maybe this time last year, or is there any, because it was such a swing last year and such a steep decline and change of the status quo, is there any value really in comparing it year over year right now where we're at?
What we really see as the real value is you have a statistical term called time period dependency. And a lot of what you see being shown today in terms of results, like, based on who you want to quote, our stuff, our competitors' stuff, you're looking at double-digit rent growth. But we really think that's a year-over-year type of calculation. And it's a year-over-year based on time period dependency that goes back into a time when the economy is really, in the state of depressed, not really robust because of the pandemic and the lack of a vaccine. So one of the things that we look at too is if you go back and pick a point prior to the pandemic and you take the rent growth today, rent growth year over year is double digit in most instances, 10, 12, you pick them. And what we do is before that, we take a period prior to the pandemic, and then we chart, and we'll take a proxy of an appropriate annualized growth, let's say 3%. And if you look at 2019 on an annualized basis at a 3% growth, where would you or where should you have ended up today? And then how does that measure? And what you eventually do is you reduce that double digit down to single digit, almost cuts it in half. So if the pandemic effects are still occurring, it's a very complex model, as Powell would tell you in terms of the Fed. And so what we really see is the impact of that. It's a mirror effect where you're trying to measure that impact. And what you say is, well, back in 2019, if we were to have a 3% year-over-year growth, where should we have ended up? Where are we today? And how does that compare? And so that really shows you the dramatic impact that the pandemic has and is having. Most people say what's post-pandemic. I don't call it post-pandemic. We're still not out of it. I call it post-vaccine phase one. And so that's really where we're at right now. And I think that, go ahead.
Yeah, I was going to say, I think we see that still in some hesitancy of certainly returning to offices, right? We've been seeing bigger and bigger companies in some indefinitely postponing, right, without real insight into when that's going to return more to normal. So how big of an issue is that with the overall economic recovery? How are you seeing current status of post-vaccine phase one? I think you called it. What are some of the issues that we're facing right now in getting to a healthier recovery and extending what seemed like a pretty bullish recovery earlier this summer until Delta came back and kind of slowed us down and put a pause on things again?
Well, the work from home issue is also one that has many variants to it. You have the ability to say that, what is the value proposition of your companies? Do I need the creative, DNA of people being together? And that doesn't mean they're together 5 days a week, but people refer to it as a hybrid model. And I think what you see is a lot of companies are saying, I need that creativity on the value proposition that I built my company from. And so what people are trying to figure out is how to do that. You see that in terms of a lot of the businesses that are springing up, the innovative businesses that are springing up right now in terms of making workplaces safer, in terms of having rules and alignment heretofore that you never have had, in terms of how the building airflow, air handlers work, things like that. So I think people are making progress in that regard, is to be able to enact the hybrid models or what they want the hybrid models to be. You certainly have large financial institutions that have cybersecurity concerns. And so all those things, weigh into how you bring people back, when you bring them back. And then last but not least is you have the demographic of people that say, do I want to be in the office? Am I an independent contributor or an individual contributor? Do I have to be in the office as much as someone who is more of a teams-oriented contributor? And those things all go through in terms of the DNA demographic of your office pool.
I know we'll talk in a little bit about some of the rent growth trends, but I'm curious if you guys have seen any link between, is that a driver with working from home and people maybe changing what they're looking for in space in their home or apartment? Have you seen that reflect any of the other metrics, either just overall occupancy rates or rental rates? Has that affected how people use that space now with the change of more working from home?
Yes, we've seen it. Our sister division, Rent Cafe, used our data as well as another division's data. And they took a look at the migration patterns of renters. And what they found is it was more of a hedonic model in lots of instances, meaning it was a consumer behavior. If I were in San Francisco Peninsula and I had a better opportunity where I could work from home and I could get a larger place in Oakland, there was a migration. This, not significant, but it definitely picked up on the scale of things like that occurred. So what we see is that we see renters moving around, not very far from their original point of housing, but they are looking for better deals. You look at millennials in particular who are aging, who should be out looking for homes, who are not, because their home affordability and the home availability is just not there. So in most instances, they have or will be starting families, and they're looking for larger places that meet their price. And some of those occur in what we call the exurbs or the suburbs in terms of major metropolitan areas. And that is occurring as well. That is one of the driving things why we got into the single family or build for rent, is because they look like a house, they act like a house, they're a little bit larger in some instances than a normal apartment, and it gives you the freedom to do what you want to be able to do. That's one of the reasons why the market, especially large REITs, have latched onto them, especially after the 2008 great financial crisis, and that's why it is becoming such a very exuberant and robust type of business right now, because it's seeking its own level, trying to provide price point for renters and give them the type of things that they demand.
Yeah. And again, we'll definitely want to cover that trend of the single family for rent in the supply when we talk about supply a little bit. But back to the general economic outlook. On a recent podcast, we had Peter Linneman on, and we were talking about this influx of money into the system created this demand, and the supply chain just got completely shocked, right? It couldn't keep up with the demand from all the stimulus money. He was saying we're still a ways out from that supply chain coming back online with, in commensurate with what that increase in demand was. How has labor affected that, material shortage, supply chain management issues? How is that affecting our recovery right now, and any forecast or outlook on what that looks like over the next, 1 to 2, 3 years?
Yeah, I like Pete. I listen to, and coming from Wharton, he's a very august person. So the availability of materials and laborers is very key in terms of this. Again, it's dependent upon the different types of markets. You can't make an all size fits one market. So certain markets are more impacted, especially the secondary and tertiary markets as opposed to the primary markets. You also see the supply chain still, moving in leaps, even though Port of LA, I think, had their highest, volume in the last 18 months, just last month. So you start seeing the ports coming back and you start seeing the supplies coming back, but it's still not at the level that it needs to be. Because you've had a lot of forward buying. People have done forward buying, and Amazon is trying to accommodate that by putting fulfillment and distribution centers in terms of same day, where their demand is. It's not a random act as to why they located in Dayton. that's a big source of their demand. So on the top of the supply chain hiccups, what they're trying to do too is to meet that value proposition of same day or 1 day delivery. And you see Alibaba, which is the big Chinese, equivalent of Amazon, which also wants to get into the game. Well, they're a whole, international date line away, and they're going to deliver stuff within same day. So they're going to have these remote centers like Amazon is, like with fulfillment and distribution centers. And so that is being built.
Alibaba's going to be doing same day delivery here in the States, in the US?
Yep. It was in the Wall Street Journal about a month or so ago. Yeah, because it's such a lucrative thing, because the buyer, the consumer now, has come to expect that. And they'll say, I'll buy from you if you give me that. So again, it's a hedonic principle where they're offering that. And UPS just made a purchase. It was, again, in the Wall Street Journal. They're actually getting into the fray in terms of doing same day with minivans and special shuttle vans that are allowed to give same day service. So again, it's a very competitive atmosphere. And what's happening is the whole supply chain, like Pete talked about, whole supply chain dynamics are changing in addition to what they were before.
Yeah. We had one of our companies that went through the same program that we went through in our batch in Y Combinator, Doordash. They're now doing that as well for retailers, delivery beyond food, right? Normally they start out as food delivery, but they're opening up their platform for same day, same hour shipping almost for local goods. So I think it's fascinating to see as that consumer behavior shifts. I mean, I'm super impatient, and I was always happy with, maybe 2-day or 3-day shipping, but now to see things coming same day is just, it's got to be a logistics nightmare to try to figure that out. It's pretty fascinating.
Especially with things like groceries, because what you have, Walmart has a proprietary system that they're developing where they're installing, being able to install inventory above the drop ceilings that they have. And that's how, when Walmart gets into the fray, it's serious. So most of the stores or the infrastructure have not, it was a just-in-time since the 1980s. Just-in-time type of delivery. You keep a very low amount of stock. You have a pretty good supply in terms of your economic order quantity algorithms. Well, now that's all being changed, and instant gratification has now entered the fray. And so what you see is, well, how do I handle that? Stores, especially grocery stores, are looking at remote substations where they carry inventory, which has a very quick turnaround time to be able to get it into the stores for buying or whatever occurs. And also, if you go to a grocery store, you see a lot of people driving these carts, putting bags together for instant delivery to somewhere else. Probably, at least 10, if not more, percent of the people in the store are not even there. They're phantoms or ghosts. These people are doing the shopping for them.
Yeah. It's fascinating to watch. I guess, so given all that, where are you in terms of bullish or bearish on the economy and maybe stabilization or continued growth over the next, call it 18 to 24 months?
Continued growth, very bullish right now, especially in commercial real estate. Industrial, which is all part of the supply chain, multifamily, very strong in terms of low risk. Even though the cap rates have depressed a little bit into the multifamily, there's still probably one of the best ways to deal with the situation. And also, it's probably one of the most resilient against inflation. And Jerome Powell has talked about inflation and, the constant need to monitor what's going to go on there, because you always have that in the background. And so the two primary commercial real estate endeavors that have that right now are multifamily, industrial. And there's a lot of things happening that people are pruning their inventories, their portfolios, to be able to look at some of these alternative assets like student housing for one, like self-storage for another. I mean, self-storage does very well and has done very well over the course of the last 18 months, probably more than people expected as an alternative asset. I need a place to keep products. Small businesses are using self-storage to keep inventory and things like that. So it's a very good. Student housing, as the colleges start to open up, I don't know if you've ever been in dorm rooms, but they're not exactly big. And
No,
so,
they're not.
you need some place to be able to accommodate that. So what you see is a lot of that going on in terms of storage and self-storage, but also student housing in terms of their enrollment effort. We have one major university here at Arizona State University. They just opened the first apartment complex, which is, I would guess, about 2.5, 3 miles from the university itself. It's on a major thoroughfare, but they give you free Uber service. That's one of the amenities. You don't need a car. There's no parking. And you use Uber or you use the light rail to be able to get to and from the university. Or if you want to go, to the restaurants or things like that downtown, you got a free pass on Uber or Lyft.
You said that was a university developed property or a private
It was private. The way that the Arizona State University does a lot of it out here, they've pretty much divested themselves of the dormitories, and they've given that over to the developers in the valley. And so what you see is the development activity and a lot of universities are doing that or have done that. The old style where the colleges are under a lot of tremendous P&L stress. So do I maintain these buildings, or is someone that wants to professionally manage them and development, can they do a better job? Can they make it more, cost effective? We'll bring the students, you take care of that end. It frees up equity on the college's from the standpoint, and it's good news for the developer as well.
Well, since we're talking Arizona, let's maybe switch over to some rent growth trends. Phoenix leading the year-over-year rent growth. Why don't we take a little bit of a look at just nationally, what have you seen in the last 6-7 months in terms of rent growth, and maybe with some of the drivers behind that? I know housing affordability being one of them, and just supply to available housing. Be a little commentary on what you've seen there.
Sure. The Southwest and West is, all the way from Dallas to Vegas to Denver are looking very hot right now. And the reason for that, there's migration patterns, not only of the millennials or the Z-type generation, which is the primary renter of the future, replacing the millennials, but also you got boomers. Boomers are making up a larger and larger percentage of renters that are driving the rental market in terms of they divorce themselves, if you will, from the maintenance and cost of maintaining a home or single family. And they move into rental engagements, especially in those kinds of cohorts or communities that foster that, rental communities that have that kind of demographic. And so we see a lot of that going on from a migratory standpoint. We also see boomers. What's interesting is boomers like to go to the central business cores. In terms of where you live and things like that, you'll see a lot of boomers populating the central business districts as opposed to the other millennials, which are, primarily in exurbs or things like that, or around major university hubs.
And now, if we look at the numbers behind that in terms of some of the fastest growing rental markets nationally, year over year, up 10%. Again, Phoenix leading the charge, over 20%. Those numbers, like you mentioned before, if you look at that time adjusted, kind of taking into account the lost year of 2020, maybe those numbers are tempered a bit more, trending up from 2019, but still those are pretty substantial numbers in terms of rent growth. So maybe walk us through some of the faster growing rental markets and what you guys are seeing there.
What we're seeing is the lack of, housing availability, especially as the millennial generation looks to find that if it is not present, they're going to continue to rent. So that's number one. You see it in Vegas, you see it in Denver. And it's also wage growth, has been moving up. It took a slight dip in 2020, but that was because of the employment situation with the pandemic. But it has been moving up as opposed to before that. And so wage growth is slowly increasing, but probably not as quickly as the rent growth is. But we see that as the ability will eventually stabilize. It's a transitory thing that probably over the next 12 to 14 months, you'll begin to see the stabilization of rents begin to come down a little bit more because of the initial surge, if you will, people that want to move or renew and things like that in terms of rental opportunities where they can get more for less, things like that. And also the population migration is occurring to jobs, workforce is moving to those type of jobs in cities where, there is a greater degree of employment.
And now, when you mention the stabilization, do you think that'll be just a slowing of the growth rate year over year, or will that be actually, will we yo-yo back, right? Have we gone so far in terms of this supply demand imbalance that's pushed it up? So you're not seeing necessarily a pullback
No,
of where rental
more
rates
of a
are, but just a
slowing.
slowing of that growth. Okay.
Yeah, because again, it's a good game. It's a less risk-free game. It's good return on your money, so that's where you're going to find it.
Mm-hmm. And I mean, looking through, and again, listeners out there, I'd highly recommend downloading the report if you haven't already. When you listen to the episode here, it seems like these are fairly well geographically spread, right? You've got Phoenix, Tampa, and just kind of going from the top down: Phoenix, Tampa, Vegas, Miami, Inland Empire, Raleigh, Atlanta, Charlotte, Austin, Sacramento, Nashville,
Mhm.
Denver, Portland. So I mean, it seems like it's a pretty well geographically diverse trend that you're seeing here in these faster growing markets. Is it a reflection of some of the migration patterns, or is it again, kind of rising tide thing? Do you
Definitely
see
the migration.
concentration?
Yeah, definitely the migration patterns. Also, that we're seeing a lot of movement in terms of where people, come from and to, in terms of headquarter moves. Disney just relocated to Orlando, 2,000 workers or planned to. And so what you see is headquarters, that are changing and obviously taking workers and increasing the workers' sensitivity to where they want to live. Certainly taxing inputs have a definite, impact on the taxation. The Northeast is typically seen as a higher taxation
Mm-hmm.
area as opposed to the Southeast, right to work laws and things like that. So you have a little bit more liberal, progressive type of folks. And you also have those areas like Denver and Orlando, and Miami, where the policy folks are coming together and the governmental folks are coming together to be able to incent and to bring employment and the economic diversity and engines necessary to bring renters or homeowners to their particular area. So that's part of the migration pattern that you see.
And what about some of the gateway markets, major metros? There was a lot of talk about the migration patterns out away from the more urban gateway markets. Certainly last year, right? This time last year, that was a lot of talk about that. Have you seen that reverse or stabilize? Where's the out migration from gateway cities? What's that looking like?
That's an excellent question because in the next 2 days, our Rent Cafe, everyone should look for. Rent Cafe is going to come out with a link on that very question, the suburbs. And so suburbs or even further. So Pete Lindeman, has talked about the fact that, look, cities aren't going to dry up and blow away. They're there. Jeff West has written a particularly great piece. It's called Scale. That's the book. And it talks about the economic diversity that goes on cities and bringing people together in terms of how that occurs as opposed to, secondary or tertiary markets. Not to discount secondary, tertiary markets, but there's a lot more synergy in large metropolitan MSAs than there are in terms of secondary or tertiary markets. Notwithstanding, though, there's a lot of development that goes on in those, but we've seen a lot of international investment in the secondary and tertiary markets because they're trying to stay ahead of competitors. And so people are re-engaging with investment. Look for the West Coast, Southwest, the markets along the whole West Coast to begin seeing a lot of North American type of investments. I think North American investments probably right now for the monies, CBRE just did an analysis of it, but about 60 to 70% of the investment in terms of commercial real estate right now has been from the North American continent, very, very little from the European and Mideast.
Hmm. And that being a change from what we had seen the last 6, 7 years.
You saw a lot of Asia Pacific stuff that
Yeah.
came in, especially on the West Coast, and that has been diminished. for various reasons, policy and things like that. So, but that doesn't necessarily negate the fact that there's still investment coming from the outside world. It's just that they're looking at a little less competitive areas, like in secondary, tertiary market.
Yeah. So now, if you look at you're running down this list of the faster growing markets from a rental rate perspective, are you bullish on all those? Are those trends going to continue? Do you see any signs of again, we talked about maybe some slowing of that growth rate, but not necessarily a reversal? Are those markets pretty consistent with the ones that you're most interested in right now from a continued growth? Or are there any sleepers that maybe aren't on that list that you guys have been paying attention to?
Well, some of the sleepers that we're paying attention to are places like Charlottesville, Savannah, Georgia. Those type of places. They're small, but what they have is a great infrastructure that's building infrastructure in terms of distribution supply chains. Inland Empire has gained a lot of credence, especially with the supply chain surge. So if you pepper in the new model of supply chains, what it is and what it will be, it's beginning to put new life and renew some markets that heretofore we've never seen have that kind of diversity in it. So yeah, we fully believe that they're going to continue and they're going to be very robust going forward.
Good. So then moving on to the supply side of the equation, I think it's been talked about for a long time that the multifamily space, certainly when you're talking about Class B, workforce housing, there's a pretty dramatic undersupply historically. Sounds like that's just further exacerbated now with everything that's going on. So what are you seeing on the supply side? Is the affordability thing ever going to be solved? We've got construction costs coming down more in line, right? I mean, we had a number of projects that were going to be going up on the marketplace, development deals that they had to put on pause indefinitely when lumber prices went absolutely crazy. What are you seeing generally on the supply side for multifamily?
Absolutely. Let's unpack it. I mean, will it get better? Yeah. Will it be overnight? No. And so what we're seeing is, in terms of the market, though, is already beginning to react to the availability. And there's two words: adaptive reuse. You're seeing a lot of infrastructure like offices that are, or even condos that are being reconverted to apartments. There was just one yesterday in the Wall Street Journal, I believe it was, in Inner Harbor in Baltimore. It was a 1967 building. It was office. It wasn't populated. It had really had a meltdown, and it was reconverted totally top to bottom in 2018. Is now leasing up. It's a pretty nice place. That's just one example. There's many more. As a matter of fact, our data is going to be used in a NIOP piece that's coming out at the end of this month. I think it's on the 29th or the 1st of October. It's going to be presented in terms of adaptive reuse of multifamily, from other types of asset classes. Also, Rent Cafe is also republishing an article that was done in the spring about adaptive reuse and where it's occurring. That's going to be republished in using our data and some of our sisters divisions data this month too. But adaptive reuse is really, some people think of it as a niche, but it's becoming more of a niche as opposed to initial niche. And that's the market's way of reacting to the fact of availability of housing.
Yeah, we'd seen even a few managers that we're working with looking at like extended stay hotels and converting those into apartments, right? Which is another, I think, maybe an easier conversion than an office to housing, but that's definitely seeing more of that out there. And how you mentioned the single family for rent product too. That's a fairly new. I mean, obviously you had all the bigger institutions buying up thousands, portfolios of thousands of homes around the country, but this development of single family communities specifically for rent, that's a fairly new initiative. How are you seeing that affect the multifamily dynamic? Do you consider that it's kind of like multifamily? It kind of acts and behaves like multifamily? Where do you fit that into the equation?
Yeah, it's definitely part of the multifamily. We have over 90,000 plus properties right now in terms of our single family rent portfolio. And, it's in the 2008 meltdown, the great financial crisis, you had all these RIOs and, bank-owned properties and things like that, and mom and pop. And that really filtered out a lot of people in terms of you had a lot of vacant properties that were being taken over by larger asset managers. And what they found is that the larger asset managers, in terms of financials, usually do a better job. They can reduce the expenses by as much as 20 points in terms of running a collection of properties. So, and it makes investment sense. So what you see people like Blackstone, things like that, BlackRock getting involved with this, the large major REITs are starting to, homes for rent, people like that, see that there's great dynamic, great profitability, and also segues into the dynamic of people wanting housing and not being able to find housing. Economics 101, Milton Friedman, bless his heart, is coming back to look at this as a viable option, and quite a significant viable option where it can be managed efficiently and profitably, and it gives the consumer what they need.
Now, you mentioned in the report a handful of markets that have a large number of new supply coming online. Charlotte, Austin, Raleigh, Twin Cities, Orlando, and Miami, ranging from 3.5 to 4.2% at the highest in Charlotte. What does that look like in more? Is that an abnormally high number? Like, give us some context, I guess, of if 4% of the existing stock is coming online for new supply. What is that relative to maybe more historical norm? And what, will that have a dramatic effect on rates there, or is that just only a partial addressing of what the underlying demand really is?
Well, the demand or the supply, if you will, is really related to the demand. And so, you could say, well, the percentage of existing stock was built based off of a certain type of demand, and that demand may be changing. Quote, case in point, Austin. So if I looked at what Austin's percentage of supply to existing stock was, 3 years ago, and said, gee, that looks a little bit high. It was like 2%. Well, now you're already up to 4% and you don't have enough housing to fit the bill. And so it really is dependent. It's a push shove, if you will, as to what the demand and all the other factors weighing into the demand. Is migration increasing? Is the technology diversity driving more and greater population growth? That's really one of the things that we look at. Our supply forecast that we do for both, residential and all the other commercial asset classes is really showing a continuous consistency of supply. We don't really see any major valleys occurring out there, that it's continuing to grow at a pretty set rate, especially in those markets like the West and the Southwest that have large inbound migration patterns, net inbound migration patterns, and you have the demographics that are able to support it.
So seeing these numbers, 3-4% of existing stock coming as new supply, absent an understanding of the demand dynamic, also, you have to look at it in conjunction, right? And if there's, call it 8% more demand, in terms of total units, and you're only building 4% of the stock in new units, there's still going to be an imbalance there.
Right. And also, to your point too, will it have an effect on rents? Yeah, it will stabilize rents a little bit. There will be a dampening, if you will, but it won't be a negative dampening. And so what you'll see is part of that stability as new demand comes on and competition takes hold, you will see that competitive pressure, which is true of any market dynamic. And so that will have that effect.
And now, economics of new development often dictate that it's, higher end Class A kind of properties that usually are being built. Certainly, as we talked about with this massive increase in construction materials costs and labor, labor shortages, labor costs. Are you seeing anything in the sub Class A when we're talking about new supply?
Oh yeah, yeah. We see these. Also, that's where a lot of this affordability reuse is occurring, and you also have a lot of affordability housing that is being done by nonprofits like Jamboree, people like that, that are bringing a lot of housing in from government stipends, from the low-income housing tax grant, from opportunity zones things like that. So they're using all the wiles that they have to be able to reduce the cost of being able to develop in key areas.
And so how are construction materials looking now? Again, we had a huge spike. Lumber certainly has come back in line. Generally, where are you seeing construction materials, and what's the forecast there for the near-term outlook?
The material costs seem to have stabilized. It seems that the major uh, impetus right now is to be able to find enough workers to be able to do the work, because a lot of the workers have changed job skill sets, retired, whatever. And now what you have is, with this resurgence in housing, again, from where it was in 2008, it's going to take retraining and things like that to be able to build a workforce back to be able to accommodate it.
So more of that impact is going to be felt by labor force than necessarily just hard costs.
Yep, exactly.
Yeah. And are you seeing that any geographical disparity in that, or that's pretty well across the board?
Primarily, it's pretty well, the gateway cities are definitely the biggest, they pay the higher wages to get to the big part of demand. So, LA, Inland Empire is going to have that, as opposed to some of the other smaller tertiary places like Yuma and Central Valley, things like that. So they're going to draw away the labor content at that price, as opposed to the smaller tertiary markets.
And so if we're still, even with some of the larger percentage of supply coming online in some of the cities we just talked about, if we're still undersupplied, how much of that is a function of these labor and materials issues versus, like, are we still, even if we're building a fairly large number of units in some of these markets, it sounds like it's still not enough. How much of that is driven by this labor and material shortage, or are there other factors that are preventing more supply from coming online to meet that demand?
Well, I think that's one of the things that the government is taking a look at when you see Biden's plan for increasing the housing stock. Part of it is time. How long does it take you to build housing stock to be able to accommodate the existing demand for the population that may change in terms of not wanting to own, preferring to rent, things like that. Portland is probably a pretty good example of that. It's a lifestyle type of community. Some people that say, "Look, I don't want to own a house. I'd much rather rent, but I want to rent a nice place, and I want to have amenity rich type of environment. I want to have Wi-Fi, broadband, that type of thing. I don't need a tennis court, and I don't want to mow my yard." So those type of things are going on. And so what you see is a lot of the government interaction being able to help reduce the cost, all the cost variants that go into it, to be able to make housing affordable. Again, it goes back to Adonic's, where do I want to live based on my lifestyle and the demographics, and can my wage and salary be able to fit it? And how will wage and salary growth continue to rise? And then you have to add the unknown tax. With the unknown tax, or the stealth tax, is inflation. I'm making more money now, but I don't have. There's just I think it was an article in Wall Street Journal this morning that said I'm making more money, but other things are, like cost of gas, things like that, just take more away. So again, the inflationary spiral, and one of the things Jerome Powell is looking at is how to be able to contain that, to be able to maintain that the economic prowess goes forward.
And are you more in the transitory camp of inflation right now, or longer term concern?
Based on the initial data that we're seeing, it's still too soon to tell, but I would say more in the transitory camp than the fact that it's back to the 1970s and gas lines going into and I think there was a place I bought in 1980, and I think I had a 17% interest rate on it. I don't think we'll be there anymore.
Yep, let's fingers crossed. Hopefully not. So then, wrapping up the report, getting a little bit of the capital markets, what have you seen in transaction volume around the country in the last year or so?
Well, transaction volume obviously has been diminished as opposed to what it was prior years, but it is starting to creep back up. What we do see is people are pruning their portfolios. They may prune their portfolios in terms of properties that they own, and look at some of these different asset classes. like single family rents or students housing or self-storage, which have great profitability tails to them. So what we see is people may want to, from an investment standpoint, see that we see a lot more significant investment in the West, buying in the West as opposed to and selling in the Northeast. So those are the two things that we see going on right now.
And from those charts that are in the report, is there any insights that listeners, as they're looking at investment opportunities, does a market that bottomed out in 2020, and I mean, looking at some of these here, Baltimore is up 22% year over year, Boise up 58% after being down 30% last year. Suburban Chicago, you have down 70% in 2020 and up 106% this year. Comparing that to some of the markets that have maybe continued to see a decline in 21 over 20, are there insights that people can look, how should we interpret some of those figures? Is that a sign of greater recovery in those markets? Is it a sign the markets that have continued to see decrease in transaction volume? Is that a buying opportunity? How can you help listeners make sense of some of those figures in the report?
Well, we certainly have a wealth of additional data to be able to supplement that in terms of our subscription services that people can look in, and they can do different types of computations. It's really on what kind of strategy, and again, it's a strategy by strategy in terms of a business. What type of business investor are they? Are they a buy and hold for 10 years? Are they a buy and hold for 3 to 5? Are they an adaptive reuse buyer and then get out, that type of thing? And all those have different variables that are associated with them. That's one of our, value propositions this is just one report that we publish, but when you really start to peel the onion and get into the other variables that we offer, that's really the value proposition that Yardi Matrix has in terms of the valuable and deep data that are available. But I would say that do your numbers, do your research, which all these folks are good at, and come to us for the type of appropriate data that you need.
Okay. You mentioned a lot of the capital is coming more from now North America, Canada, and kind of a decrease on some of the money coming out of Asia. What is the composition of buying activity look like? Is it more private equity? Is it individual mom and pop? Is it REITs? What does the composition of the buyer world look like these days?
A lot of REITs, a lot of private equity, not so much boutique owners, but there are some. So, but in terms of your question, it would be primary, a lot of REITs, big guns are getting involved.
Yeah. And how about on the debt side of the capital markets?
It's hard to assess that one right now. We're still going through the data. So I'd rather not comment on that until we do some more looks at it.
Okay. Well then, Doug, I think that's pretty much what we've got. Made a quick run through the report there. We're certainly going to have that in the show notes. We always like to ask our guests here at the end, what's keeping you up at night and what has you optimistic here as we look in the getting into Q4 of 2021.
Well, I'm optimistic about commercial real estate in general. What keeps me up at night is the inflationary aspect, the hidden tax that goes on. But I think in terms of the most risk averse, whether you're looking at tips, whether you're looking at commodities, whether you're looking at stocks and equity or commercial real estate is probably the most risk averse type of investment that you can make right now.
Okay. Well, I think that's a pretty good spot to end it. Doug, again, you've been super gracious with your time. Really appreciate it. Why don't you let the listeners know how they can learn more about what you're up to with Yardi Matrix?
Sure. Just you can call me. Give me a call, doug.ressler@yardi.com. You can give me a call, 480-695-3365, or you can visit us, yardimatrix.com, on our website.
Perfect. And folks, we'll have links to all of that great information and to the report in the show notes. So, Doug, thank you again so much for coming on today. We always appreciate the conversation.
Thank you, guys. It's always a pleasure.
All right, listeners, that's all we've got for today. As always, please send us any comments or notes to podcast@realcrowd.com. And with that, We'll catch you on the next one.